Hello and welcome to Scope's webinar today. Today we would like to speak about technology stocks, which have been the best performing sector last year of all sectors, which was also driven by an exceptional year 2020, where the global pandemic led to a leap of digitalization, which nobody expected in advance and which was a driver for a lot of companies' returns. Especially companies related to business people had to do at home, like Zoom online meetings or HelloFresh, food delivery services, which have soared in price already significantly. But today, it's more about having an outlook and speaking about future and current investment themes and trends and the related companies, so where you still find opportunities in the market. And also we will speak about what the current challenges are and what is new in Silicon Valley. To answer our questions, we have an expert here today. It's product specialist Julian Cook from T. Rowe Price. Julian sits in San Francisco, right next to the Silicon Valley, and will answer all our questions. Before we start, I would like to say a few words about T. Rowe Price. T. Rowe Price is an independent global investment management firm founded in 1937. With more than 700 investment professionals, they manage a broad range of active equity, fixed income, and multi-asset strategies. The company is global and present in 16 countries, and it has 1.2 trillion euros in assets under management, where the majority is invested in equity strategies. Typical for the company is the proprietary research and their collaborative investment style. Before we start with the webinar, I just wanted to give you some technical details. You have the possibility as the audience to ask questions to Julian directly by typing them into the chat window on the right side, either in English or in German. I will translate that. But now I think we are good to go. So let's get started and move on to the Q&A session with Julian. So hi, Julian. It's great to have you here today.
Hi, Barbara. Yeah, thanks for having me. Can you hear me okay?
Yes, I can hear you okay.
Wonderful. Thank you.
So great. And then I would jump right in with the first question, because we all are curious about the investment themes. So which are the main investment themes you currently see in the market? How do you cluster them? And through which companies you reflect them in your portfolio?
Yeah, certainly, Barbara. It's a good place to start. And I'll just put these slides up. Hopefully you can see them clearly. Okay, so firstly, thank you very much for your time today. Really do appreciate the opportunity to share some thoughts about tech investing in the US and also globally. I think that where we come to this question is we really do invest globally on a bottoms-up basis on the companies we have in the strategy. So just going to this first slide regarding themes. So if I think about the main themes in our investment strategies, we look at technology, we kind of have them in these sort of 5 buckets. And to really sort of bring it to life a little bit, so in cloud computing as an example, there are 3 areas of cloud computing which are still of great interest to us. That's infrastructure as a service. So that's companies like an Amazon that provide kind of the backbone, or an Azure, arguably, as a backbone to sort of cloud transition. Then you have companies which are, I guess, more like sort of software as a service platform companies. So things like Workday or ServiceNow or Salesforce.com. Those companies that kind of sit on that infrastructure. And then also platforms as a service. So companies like Shopify look really interesting to us. In terms of high quality internet, I'm not going to bore you with the names that you already know. You already know Amazon. But maybe you don't know sort of Farfetch or Etsy or those kinds of companies. Snap is another name that we have in the strategy. With regards to industrial electronics and software, that's really down to more kind of the semiconductor area, where we think that's a really fascinating space right now. Cybersecurity is always somewhere where there's increasing investments, and if you think what underlies a lot of this technology, it really is artificial intelligence and the ability to analyze data sets and make predictions to basically make your offering that much more productive and efficient. So when we think about tech investing globally, these are kind of the main themes that we end up investing in as a consequence of our individual stocks. So we find the stocks first, and this is, I guess, a good representation of the areas of the market in which we invest.
And Julian, I'm looking at these trends and themes. Are there some where you think they will have the highest growth compared to the others? Are there some you prefer?
Yeah, I'd say that if you think about I guess cloud computing, we're still very early in cloud computing. If you look at companies like sort of PepsiCo, obviously it's a beverage company, or BP, a petroleum company. PepsiCo have announced that they want to take all of their mission critical applications into the cloud. So we're still actually very, very early. And for BP, for them to hit their climate and their ESG commitments, they have to take their operations into the cloud. So I know we've talked a lot. It seems like we've talked about cloud for a long time, but there's still a huge runway of growth, which is still to be developed there. So we're still very excited about cloud computing, and also still think we're pretty early in the penetration in areas of e-commerce and digital advertising.
Yes, cloud computing is also one trend we see a lot in Germany. But when thinking of cloud computing, I'm initially thinking of Microsoft and Amazon as the main providers. But are there other companies, maybe higher growing companies, you look for?
Yeah, so I guess that goes back to that point about sort of, I guess, the Amazons of the world are these sort of the infrastructure providers. Mm-hmm. And then you have platform and you have software under that. So the highest growth companies out there are more likely to be software as a service type companies, which basically sit on this terrific infrastructure. The infrastructure is also really persuasive for the client, because they can basically take on what they need to use right now. So you don't buy like a huge software package as a fixed cost to your business. You can basically use it incrementally. So you've introduced a variable cost element into your business, and being, I guess, as a cloud service, that can actually scale really rapidly. And so if you have a software as a service offering which gains traction with your customers, you're able to deliver that on a scaled basis. And I think one of the challenges and one of the opportunities investing in technology is really recognizing those companies that can actually scale extremely quickly. And I think that's what software as a service on top of the cloud platform enables you to do.
Yes, so scalability is key, and it's also because you have the lower fixed costs, which can enable you higher growth. Yeah,
and I'd say also what's really interesting when you look at, I guess there's the third infrastructure provider, which is so you have in the US you have Amazon, Microsoft, as you correctly mentioned, and also Google Cloud. I think what's really interesting is such as the deflation in the price charged for these services. You have Google Cloud, which I guess at the same size that Amazon Web Services was a number of years ago, making a very nice profit. Google Cloud is now burning about $5 billion a year at the same size. So if you've come to this party a little bit later, you've got to get to greater scale to reach profitability. And it also means it's really tough for a fourth competitor to come into this space. So you think about infrastructure as a service, it's really tough to come into this market, even if you have the scale of Google and you're losing $5 billion a year at your current scale. You need to get greater scale to get the economies.
Okay, thank you very much for that, Julian. I have another question about upcoming themes and trends, which is maybe captured in the part fast internet access, is 5G, because in Germany we see that the sale of 5G devices is not picking up as planned, because people are still using their 4G old devices. So it's not, maybe you won't benefit so much from it, of having like distributors of mobile phones, or maybe the network, but how would you benefit from the trend, and how do you see the outlook for that trend?
Yeah, that's a really good question. I'd say I'll just flip forward a couple of slides I have something on 5G here, and I think you hit the nail on the head. I mean, this chart shows data usage, and that's the dark blue line, and then the light blue line is what we pay as consumers, so the average revenue per user. Now that's a problem, because you've got increased data usage, but you've got deflation. And so when we think about where we want to invest in a powerful theme like 5G, we don't want to be investing. Let's just use this sort of similarity. We don't want to be investing at the beachfront, where you're selling sort of infrastructure and equipment and telephones and service providers. What was actually really interesting, obviously, I'm sure the audience is familiar with a company called Huawei, Chinese telco equipment company. So recently, it was really instructive that they were prevented from selling their equipment into the US market, and also, I guess, in Western economies also. So we speak to Nokia and say to Nokia, so now that Huawei, who's obviously a low-cost provider of this equipment, now that they're no longer on the scene, when you go into these 5G discussions, then surely you're getting it. The pressure on price isn't so much. So maybe you have a chance to raise price. And Nokia turned around to us and say, well, actually, we can't raise price one bit, because if we lose what is a 10-year contract on a 5G investment, we're out of it for the next 10 years. So we can't afford not to be part of that contract. So pricing for telco equipment is absolutely brutal. So you don't want to be investing at the beachfront in 5G infrastructure. You need to be stepping a few streets back. So what do I mean by that? You need to be investing in companies like a Dutch company, ASML, which has a near monopoly position in extreme ultraviolet lithography. In layman's terms, it means they can project a very thin line of light on a piece of silicon to make the best chips. We're also investing in a company called TSMC, Taiwan Semi. Now, it's probably not an understatement to say that given the importance of semiconductors right here today, that TSMC is probably the most important pivotal strategic company in the world. It's based in Taiwan, just off the base of China, just off the coast of China, pardon me, and it's probably the most important strategic company, because semiconductors is seeing an end to Moore's law, where the productivity that's been basically part of semiconductor development for the last 30, 40 years. The advance in speeds is basically plateauing. So what does that mean for semiconductor companies and semiconductor equipment companies? It means that the cost curve is going up, and it means you can now the cost curve is flattening, and you can actually charge more for that product. So semis, we think, is actually a very, very interesting part of the market as Moore's law sort of peters out.
Well, thank you very much for that, Julian. So it's not the first thought that comes to your mind when thinking about 5G and investing to semiconductors, but these are the companies that really benefit most from the trend. And we have seen that there is a high price pressure for providers of equipment, like Nokia.
And actually, I'll just add something else. Actually, the places that are going to pay for this 5G. It's basically persuading a company like Siemens, a great German company. It's persuading Siemens to install 5G in their automation facilities. So to improve the efficiency of automation and their factories, that's where 5G is going to get paid for, not by the consumer. Mm-hmm. So we all look at our own mobile phone bills, and we can see them generally declining. And so we're not going to pay 2x our current mobile phone bill for a slightly faster download speed of a movie. We're just not going to pay it. Mm-hmm. But it's going to be the likes of Siemens who want to see an advance in the productivity of their automation. Those are the kinds of companies going to be paying for the 5G upgrade, not the consumer. It's all going to be done by sort of industry and enterprise.
Okay, thank you very much for the insight on 5G. As next theme, I would like to move over to the fund you manage and your investment team. And my first question is if you could tell me a few words about how your investment team is set up, where the people sit, and how they collaborate with each other.
Yeah, sure. Let me just go a few slides further forward, and I can hopefully share this with you. We'll come back to a few of these a little later. So So just a very brief comment on the strategy we have here. So it's run by Alan Tu, who's the portfolio manager. I'm the advocate for the strategy outside of the US, and hence I guess that's why I'm here today. And so in terms of the resources we have available, we have a large research team. Here they are, a large research team. So there are about 25 people on this slide, all of whom contribute to the ideas and the insights that we generate on the companies we invest in. As Barbara, as you mentioned at the outset, it's a very collaborative organization. And in terms of the staff members here, the guys on the left side are based in the US, and the guys on the right side are based all around the world, whether it's in Asia or in EMEA. And in terms of their contribution, it's really it's their job to help develop insights on individual companies. Now, T. Rowe Price, again, we run a lot of assets under management. This group, in addition to working with Alan Tu on this strategy, this group is responsible for $400 billion of client assets under management. So it's a very well-resourced team, and it's through this effort that we we hope to generate insights on the companies that we invest in.
Yeah, thanks very much, Julian, for that summary. I can also see it's a very large team and also a global team. So you have people all over the world, because as you've mentioned, you have also some Asian stocks, for example, like Taiwan Semiconductor Index. So it's good that you have coverage on the ground. So I'm asking myself the question, how is the research generated and how does it fit together in the portfolio? So how is the investment process working within the team? And also, how do they look for new investment ideas, and how do they define the investable universe? Could you please tell us a little bit about the team's process and how is it executed?
Yeah, sure. So I'll put up a slide up in a second, which sort of goes and talks about what the kind of things are that we look for in a company. But first of all, it's what the way we define the universe is. It's really companies, I guess, technology companies or companies that are, I guess, are benefiting from technology. We can sit here today and we could all agree that Tesla, being an auto company, it's as much of a tech company as it is an auto company. So I guess some of these lines of definition need to be widened because they don't necessarily capture what is really going on. We invest a significant proportion of this strategy outside of the MSCI Information Technology Index. Because when we look at companies like, as I mentioned a little earlier, sort of Farfetch or Etsy or Snap, none of these companies are in the Information Technology Index. So about 30% of our investments are basically outside of what would be sort of traditionally defined technology. And given the impact that technology is having on companies and improving the way that they can deliver a product to market, I think you have to have that wider definition. In terms of what actual things we look for in a company, we kind of put it on this slide here. So what thing do we kind of look for? And I try to sort of summarize it on a PowerPoint slide. I guess we definitely have a quality bar. I think what was really instructive in 2020, when you saw that big sell-off in the market in sort of March, April timeframe, or March timeframe, we really took that opportunity to sort of hit the reset button on a lot of companies which had previously become too expensive for us to invest in. So we then went back in and made decisions on more of a 3 to 5 year time frame of which technologies do we really want exposure to on that 3 to 5 year time frame. And also within that comment, of course, we're looking for mispriced assets or mispriced equities within that. So we're not going to buy a technology company at any price. We have to be very judicious and run a risk reward framework on choosing which investments look like the most attractive to us. To give you a little example, during 2020, we took some money out of Alphabet. So we don't own any shares in Alphabet today. We took that money, we redeployed it into a company we thought had a better risk reward in a very similar area. So we sold Alphabet and we bought Snapchat. Not because there's anything wrong with the thesis in Alphabet, but if we're trying to find companies that can genuinely have an opportunity to be 3 to 4 times larger, we think that we have a better opportunity of doing that in a snap than we do owning Alphabet, given, I guess, where the market caps are. So we pay a huge amount of attention to fundamentals of these individual companies, and again, that's where the research department comes in. But these are the kind of things that we find important when we're looking for tech companies. I think something that's probably, something that's probably overlooked when you're looking at tech investments is often you're investing in areas that almost by definition haven't been proven yet. So you have to have a little bit of imagination to look out a little bit further and to sort of see where that company could potentially get to. So I think having that sort of more of an open-minded perspective, you need to sort of take a little bit of a leap into the unknown when you're investing in technology. But you have to guess you have things like a few hallmarks, whether it's a founder-led business, whether it is genuinely got an expanding total addressable market. What is the opportunity? What is the effectiveness of that company to attack that opportunity? So it's a whole lot of different facets that sort of go into selecting the right risk reward ideas for a portfolio like this.
Thank you very much for that, Julian. So can I ask for the reason of the sale of Alphabet? Was it too pricey compared to Snapchat, or was it just the growth potential of Snapchat higher?
Well, it's funny, isn't it? It's because I think a lot of the preconceived ideas about Alphabet, and actually I'll include Facebook into that commentary as well, is that people assume that these are expensive companies, and I guess the reality is they're not. So you look at the valuation on an Alphabet or a Facebook, both of them are trading sort of high teens price earnings, fully GAAP, fully costed sort of stock-based compensation type valuations. And Google is growing about 20% a year, and Facebook is growing about 30% a year. So extremely large companies with very attractive growth rates. You're trading actually pretty low valuation. So the move from taking money out of an Alphabet into Snapchat is more about what is the potential movement in that company over the next 3 to 5 years. And if we see a big monetization gap at Snap, which is our fundamental research has given us a few insights on Snap, like maybe I can talk about that if your audience is interested. When we look at Snap, they have a very loyal customer base. So they own like 95% of the sort of 18 to sort of 24-year-old cohort demographic. The biggest question on Snap is, are they able to hold on to that 24-year-old or that 18-year-old when they go to college, as an example? So, or do they rotate off and they find some other kind of, that's a kind of an app for youngsters, and I'm now in college, I need an app for somebody a bit more grown up. Our data suggests they don't rotate off. So if you've got a Snap which basically owns that demographic, they're not rotating off the platform as they get a little older, then all of a sudden you've basically got a company which owns that demographic as they get older, and more importantly, as they get richer. So Snap to us looks like a better option. If you have an exposure in that space, I think it's better to own a Snap over an Alphabet, given the possibilities of potential growth from this point forward. So Alphabet, a great company, but we think that there's a greater likelihood of Snap being a 3 to 4 times larger company than there is for Alphabet.
Thank you very much. It was very insightful also to me about the comparison of Snapchat and Alphabet. So the next question is about your evaluation framework, because I imagine it's not so traditional in the tech space, because many companies are investing into growth, but maybe not so much in being profitable. And also, I think a time frame investing to tech of 3 to 5 years, to me, it seems pretty long. So you need strong drivers. So could you tell us a little bit about how you evaluate these stocks within your framework and what you look for? You place the emphasis.
Yeah, I'd say the framework is kind of it's similar in that we're trying to take that 3 to 5 year view. And on occasion, maybe you have to look a little bit further out. But you really have to have confidence. You have the the right sort of the right kind of beginnings for the company. So it's about, does the company have a chance of being successful in that large and growing total addressable market? I think we've seen, I guess, COVID has taught us a few things regarding the sustainability of the shift in behaviors. And so as a kind of an example of how we look at companies, we're far more interested in companies that have a durable and sustainable shift towards their technologies, as opposed to being a technology which in the short term could do very well, but there's no sort of Act 2 or Act 3 or Act 4 which can basically sort of layer on further competitive advantage. So to give you a sense as to what the things we kind of like. So we own a company called Farfetch. And I don't know if your audience is familiar with Farfetch. Farfetch is a company which is an e-commerce company. And I guess they started out by distributing things from boutiques. So pretty niche-y kind of business. Then they expanded into actually having a relationship with a brand. So Act 2 was they started relationships with brands. So going direct to luxury brands and distributing their products. So that's Act 2. So far so good, but still a relatively niche business. And then they signed a deal to go into China under the umbrella and support or sponsorship of Alibaba and Richemont. And all of a sudden, it's like, well, now they can get into the fastest growing luxury market on the planet, which is China, and they can get into it with the blessing of Alibaba and Richemont. We didn't own Farfetch until we saw that company was in a position to springboard into China and be really, really effective at attacking that total addressable market. So we have to dream a little bit that they're going to be successful doing this. But if you think about the competitive barriers which are put up in front of that company, imagine trying to break into China without having Alibaba as a sponsor or as a de facto sponsor. Really, really tough. So you could spend years trying to break into that market and not be successful and just end up wasting shareholder money. But if you can actually demonstrate a pretty high probability of being successful in that new market, that's how you've got to think as a tech investor. So it does require you to make an assessment of, is this company going to be successful in its market, in this expanding market, that it can show an extreme level of growth. And so that's kind of how the framework really operates. We're not so interested. I guess when I sort of made the opening comment about the things that we own in technology, I'll tell you things we don't own in technology. We do not own Apple. We do not own Microsoft. We do not own Oracle. We haven't owned Oracle for a decade. We do not own Cisco. We do not own Intel. So those for us are technology companies which are far less interesting in our framework of really trying to find best risk reward ideas on that 3 to 5 year view. So hopefully that gives you a better sense of the kind of things that we're looking for and the kind of framework we put around the companies we're investing in.
Okay, yeah, thank you very much. It gives me a good idea what the fund is about. And we've also seen that it has paid out. So my next question would touch a little bit on the performance of the fund. And I would like you to show us a little bit how the fund has performed. I think we also have a slide in the presentation, which stocks did best and worst last year and what went well. I've also seen that performance has picked up a lot over the near term, so over the last 1 year period. So could you also speak a little bit about the reasons for that, please?
Yeah, so I'll just go and jump onto the slide, which has some performance data on it. Maybe a little small for your audience to see. You see what's gone here. Here it is. It's just in here. So it's a little small, so I apologize. I'd say I guess 2020 was a spectacular year. I guess I'm certainly not making the suggestion that that's that level of alpha is repeatable. But I also make the caveat saying just because it did well in 2020 does not preclude it from doing well in the future. A lot of the drivers that we recognize that have pushed performance in 2020 still exist. They didn't stop on the 31st of December, 2020. They're still drivers which still have durability. And if I just look at the highest I guess weighted stocks in this portfolio, I'm actually pleased to say the largest contributors to performance were actually, even on a relative to benchmark basis, were actually a lot of these names in our top 10 stocks. Company that the audience may not be so familiar with is CSEA. It's a company which operates out of Southeast Asia, and it basically has this sort of the holy trinity of what we think are successful businesses for them. So firstly, it's e-commerce. Secondly, gaming, and thirdly, fintech. Now, just to break that down a little bit, this is a company which operates it's almost like a Tencent of Southeast Asia. And it's very dominant in its market. So it's in places like sort of Indonesia, Vietnam, Taiwan, and it comes to market as an e-commerce company and is gaining share and dominance in their e-commerce business. That also helps them drive their fintech business through like an e-wallet. And then their second business, being gaming, this is a company which basically has like a low power solution. So if you think about the sophistication of mobile phones and mobile phone gamings in sort of developed markets, Europe and US, very high powered gaming. These SEA games are basically designed for lower bandwidth, lower powered mobile phones, quite frankly, and they've actually been extremely successful. And as you see gaming shift from being games to being more of a social interaction, I don't know how many in the audience have children who play on Fortnite, but Fortnite is essentially, it's a social platform where people hang out. So the game is part of it, but mostly it's a social engagement, and that company is actually doing super well in their market. Amazon had a phenomenal year in 2020. I have a slide actually that just addresses a little bit of that. So maybe I'll just take you back a few slides in terms of what happened in commerce. So Amazon and a lot of e-commerce did really, really well. What this goes to show is the tremendous penetration improvement we saw in e-commerce. So we kind of put on here as the tagline, 10 years of growth in 10 weeks. So from 2008 to 2019, that was a 10 percentage point increase in penetration. And we saw basically another 10 points of penetration in the US in the 10 weeks up until April 2020. So there's still a lot of scope here to see some decent growth in e-commerce. So again, that story is far from over, and I think Amazon has shown itself to be still at the forefront of driving penetration. I think in Germany there's about a 16% increase in e-commerce activity. I think Germany comes from a starting point of about 12% penetration in 2019, but also in Germany saw some pretty decent growth. And you think about the new battlefields, the new battlefields in e-commerce are more on the grocery side. You think about the penetration of grocery, it's less than 3% of groceries bought online. In the US, that's a $1.2 trillion market where there's low single digit penetration. Consumer electronics penetrations 50%. Pet companies 20-30%. So grocery, a huge market, tiny penetration. That's something that should get us interested. And the pickup we've seen in grocery, I guess, firstly happened because of safety, because people didn't want to go outside of their house, and so they order things online. It's now shifting from safety to convenience, and so there is some of this shift which you're seeing, which has a lot more durability. So this isn't just, we think, a flash in the pan kind of improvement. This is a step change function in the acceptance of grocery as a medium in terms of e-commerce. And then just briefly on a few of these other names in here, Shopify, that provides. We talked a little earlier about platform as a service. Shopify is one of the fastest growing e-commerce companies, not because it sells things itself, but it provides a platform for companies to go from offline to online. So if for instance you were in 2020 and you had an offline business and you wanted to get online to get hold of your customers, you could basically take up Spotify as being like a preset platform for you to for you to chase your online ambitions in e-commerce. So that stock also did well. And things like CrowdStrike. One of the things that obviously happened in the year was a move to a distributed workforce. The fact we're having this conversation via video conference suggests what most of us are sitting at home conducting business from home. The huge proliferation of different devices in a distributed workforce needs to have security. So CrowdStrike is a security company which basically operates terrifically well through as being a cloud-based security product. And as you saw, a greater adoption of this sort of work from home environment proliferation, they did extremely well in terms of a growth rate. Also, you had some data breaches in 2020 where they were brought in to firstly fix the problem and then basically stay and sort of police the problem. So we don't think that data security is going away. And CrowdStrike was also a great performer in 2020. But we think that has durability. There are some stocks out there which did well in 2020 that we think probably run out of steam. To give you a little example of that, there's a company out there called DocuSign, which we did own but sold it. So DocuSign in the world where we all have to get contracts signed. DocuSign allows you to put an e-signature on a contract. Now, for us, that saw, I guess, a great level of adoption and good penetration in 2020, but it didn't convince us that there's an act two to that business. What it's essentially done is it's essentially pulled forward demand from future periods into today. So we don't think there's a convincing act two for that business. So it goes up pretty nicely in 2020. It would be a name that we think would have a problem. It would struggle to build and compound on that, because you don't think the total addressable market has actually got any bigger. It's just brought demand forward to some extent. So we're less interested in hanging on to those kinds of names, and more interested in that sort of act two, act three type dynamic in the companies we're holding. So hopefully that gives you a good sense as to what was working and the kinds of things that we were getting out of in 2020.
Yes, definitely. Thank you, Julian. So it was really impressive to see how the online business has picked up in different areas. And we've also noticed in Germany that we had a huge pickup in food deliveries, also in ordering from Amazon instead of going to the shops. And I also think a part of the increase is going to stay, because when people try to order at Amazon for the first time, then they usually stick to it. So this is really sticky, and I also think that this growth will be with us going forward, and new people using this platform going forward. And so it's really crucial for all the shops being online, having an online business.
Yeah, and I'd also, I guess my other observation is you need to be investing in companies that could invest, through the pandemic. And if you look at Amazon as the example, they invest about $11 billion in sort of COVID investments. And whether that's increasing their spend on logistics to improve their one-day delivery or their same-day delivery, they're investing more money than FedEx, UPS, and the United States Postal Service combined. And so you've got a company which is able to invest staggering amounts of money into their logistics platform to improve that delivery. So you think about the German experience of seeing more grocery delivery. So there's a demand spike that is then met with an increasing capacity from supply. It makes the whole experience better, and then it then moves, I guess, to greater demand and greater supply. And so you have a really nicely operating flywheel to that business all of a sudden. So you've seen the step function change in behavior. And because we think Amazon are investing in that business to make the experience a whole lot better, then that's going to provide a really powerful flywheel. So that's not just happening in the US. Obviously, we think you're saying it's happening in Germany. It's certainly happening here in the UK for a greater level of, a greater level of success in penetration, because it's getting more convenient.
Yes, definitely. That's also what we observe. So I have another question about the portfolio. Indeed, because we have spoken about the top 10 position in the portfolio, And when I have looked at the portfolio, for example, in September last year, I've noticed that one of the biggest position is like kind of the Amazon of Asia, or not only the Amazon, but also other businesses. It's Alibaba. And we were all wondering what happened there with the IPO postponed and Jack Ma disappearing. So I'm asking myself, do you see high risk for companies, for example, operating in China?
Yeah, that's a great question. I guess the short answer is yes. I think so. The Ant IPO getting delayed and Jack Ma going missing. We actually had good information that he wasn't in a Siberian gulag, so we knew he wasn't breaking stones with a hammer. We knew he was okay, and I guess that was good information to have in that period of time where he kind of disappeared from October to the end of the year. But I think the Ant IPO, I think basically reawakened people's sort of thoughts and concerns about a legal framework in China. Now, I think in the US we're very familiar with the legal framework. We have representatives in Washington that go and sort of trying to sort of test the water, test the pulse of thoughts in this regard from a legal framework perspective. So in the US you have certain protections. And I think the demonstration, or certainly the reminder that we were given when the Ant IPO got sort of delayed with like 1 day to go, that kind of, I guess, also makes you sort of rethink and second question, the confidence we have in the legal framework in China is nowhere near as what it is in the US. So I think within that, we need to be sort of cognizant of sort of taking the appropriate risks. And you're right, we reduced our position in Alibaba as a reflection of this demonstrates a higher risk profile looking forward, and we could probably take some of those basis points and redeploy them into ideas that, again, going back to that point about trying to find companies that can be sort of 3 to 4 times larger. So we haven't thrown the baby out with the bathwater. We haven't sold all of our position. But at the increment, at the margin, we've taken money out of it and redeployed those basis points into what we think are better 3 to 4 time potential upside type ideas.
Okay, thank you. Before we would like to move over to the Outlook section, I have another question for you about the process, and it's about ESG integration. So I've also seen that we have a slide in there. So could you just speak quickly about how you integrate ESG investing into your strategy, and what is particular for tech companies to look for?
Yeah. So thank you. Let me just go to that slide. I think it's this way. So this slide, I guess, just try to give you a little bit of timeline of our involvement in ESG. And I guess just to sort of think about, oops, I just hit the wrong button. Sorry. And this is kind of, I guess, our philosophy on ESG. Now, the major investments we made on an ESG perspective were probably done about sort of 4 years ago. Maria Eleanor Drew came in, was hired to basically build a team to do the E and the S part of that. The G was already a very sort of well-functioning part of what we did. I think one thing that people should know about T. Rowe Price is that we vote every single share that we hold on behalf of clients, and so from a governance perspective, we take that responsibility extremely seriously. And from a research perspective, we've integrated ESG into the research. So when we conducted in 2019 11,000 meetings with companies, of those 11,000 meetings, which are like normal kind of meetups and understanding the businesses, we highlight about 656 of those were sort of ESG only engagements. And so we're getting better at cataloging exactly where the majority of the conversation is about an ESG related item. It gets tagged in our research, and we sat down the other day with the head of ESG at Amazon as an example. And part of the challenge of ESG is really getting to, I guess, materiality of the things you're discussing. And so we go to see Amazon, and the reason we see them is Amazon has a pledge that they're going to be carbon neutral by sort of 2040, which is 10 years before the Paris Accord. So we go in to see them and say, well, this is great that you made this pledge, great, but we need to see evidence of how you're going to get there. You need to show us the roadmap. We need to better understand. So we're not sitting there as a passenger. We're trying to push the company to talk about how exactly are you going to be getting to this destination. And so when we think about tech companies particularly, they tend to do pretty well on the E. So environmental, they tend to be actually pretty environmentally sound. The social aspects regards to data privacy and those kinds of issues, that's more of I guess can be more of an orange area. Think about taxation policy. Think about transparency of taxation policy. But so I'm raising sort of highlighting. We know these are the areas, and we know which areas we need to dig into. And then on the G part of tech companies, it's do they have super voting rights? Do they exercise that? What does their compensation, I guess executive compensation look like? So all of that taken into consideration comes into the research. So in that way, it's embedded not just for this strategy in technology, but also for the entire platform for all of the companies we look to invest in. So hopefully that gives you a better sense. It's about establishing materiality of the ESG consideration and really knowing where to focus in on of what behaviors need to have attention, and then engaging with that company regarding those issues.
Yeah, so thank you very much for explaining the process to us. Just to repeat it for the audience a little bit, to sum it up is that it's about the materiality of the ESG factors, and most of them are not in the environmental space, and it's about ongoing engagement with them and looking beyond their reporting, right?
Yeah, and this slide so gives you a little sort of picture of what a score would look like for a particular company. So in each area, whether it's environmental, social, ethics, we can drill down into what exactly are we looking at? What exactly is the score in each of these different areas? So it's not sort of just looking at these from a top-down perspective. We're really trying to sort of get underneath and really understand what the drivers are to these ESG scores. Because one of the things we found is prior to this investment we made in our own capabilities, is that depending on third-party research for this kind of gets you some of the way there, but often what is really valuable to understand about the ESG score in a particular area is knowing whether or not it's getting better or worse. If you know that the company is currently scoring orange in a particular area, and you know that it's made steps to improve that, then you have a bit more granular detail as to the direction of travel on that particular item. And we think understanding the direction of travel on an ESG score is almost as important as knowing what that score is in the first instance. So it really is sort of the incremental change in that score is something we're also able to monitor and check progress on, and that can also be really, really valuable as you look at these companies.
Great. Thank you so much for sharing your insight. Before we come to the outlook, I just wanted to give the audience a quick summary of the process of the fund or the key points of the fund. And here, what I have noted down for me is that not all tech-related companies are found in traditional tech indices or tech sectors, but you have to look at a wider range of stocks to identify companies benefiting from that, like in the industries, like manufacturing of semiconductors, but also e-commerce shops, like, for example, Shopify. So the universe is indeed much larger than just the MSCI Global Tech Index, and also 30% of the investments are made outside of the index. And bottom-up idea generation is key, and by generating investment ideas, then also the broader investment themes emerge through that. And then the team looks which stocks benefit most of those themes. And here is not only about the relation, but also about the scalability of the services. And here, for example, companies with less assets and the better scalability, like software, they have the much higher potential. and also the outlook for the companies. It's not only over the near term, but the companies should have long-term drivers, or at least when they have like a business benefiting from driver now, there should be the next upcoming, and not only like one-off effect, like some stocks we had in the pandemic, and then there is no second growth driver after that. So these are really the key factors. The team at T. Rowe Price looks for tech stocks for their fund, and that's also the key takeaway I have from the process and the portfolio and the people. And so the next part, and also a very important part in my view, is the outlook that Julian has and Julian and his team have on technology investing. And here I have a question already received from the audience, and I just translated into English from German. And here our participant asks, so he asks, should it mean that some stocks, some large companies like Microsoft, Cloud, or Infineon, like semiconductors, are already pretty highly valued because they are at their 10-year high? And should we look more for second-tier companies that are not so pricey at the moment?
Yeah, it's a good question. I think we tend to not. I guess firstly, we're still trying to be looking. We still want to look forward, and for us, sometimes when we look forward, we're trying to find companies that have a better prospect of growth going forward. So that doesn't necessarily mean it's going to be a cheaper company, because quite honestly, some of their success has not yet been achieved. And so on a price earnings basis, an example, those earnings may be 3, 4, 5 years down the road. So looking for a cheap tech company, I guess the ones I rattled off earlier, the ones that we don't know. So Oracle is like a 12, 13 times multiple tech company. We think that company faces tremendous secular challenge, and we wouldn't touch it. So IBM, we wouldn't touch it. Intel, we wouldn't touch it. So I think I'd be very cautious about assuming the right course of action is to buy cheap technology. I think there's an argument to be made in terms of not being exposed to the absolute bleeding edge, or the leading/bleeding edge of valuation. And I'm perfectly sympathetic with not wanting to own the most outrageously valued companies on a price to sales basis, where you have to look at 10 years to justify the valuation. I'm very sympathetic to not wanting to be necessarily overexposed in those companies. But at the same time, you need to be looking at and using your imagination and sort of understanding which companies are likely to be successful. And that decision is not necessarily going to be driven by it having a low valuation. Being a second tier company, having a low valuation isn't necessarily going to be what's going to make that investment successful on that 3 to 5 year view. And oftentimes, and maybe I'll give the example of I guess we're using this platform today, which looks a little bit like Zoom. Yeah. So you think about Zoom, and it sort of scales from 6 million users to 29 million users. But then all of a sudden, then its opportunity set increases. So a year on, so 2021, even though Zoom has gone up a lot, it actually probably looks more attractive now than it did in 2020, because the total addressable market has expanded to 300 million knowledge workers globally, where a Gartner report 3 years ago would have said the maximum number of people on doing video conferencing is going to be 7 million people. So that market has gone from 7 million to 300 million as a total addressable market, and current penetration is really low. So sometimes, I guess, with tech companies, the story can actually get better as it gets goes higher in price, because the market opportunity has changed and has developed. So I wouldn't advocate just sort of going down a list of tech companies looking for the cheapest stocks, because you might miss the next Zoom as an example.
Yes, thanks, Julian, for answering that question. Also to the audience, if you have more questions to come, we have a few minutes left, so just type them in the chat window, and I will ask them to Julian. But in the meantime, the most important thing is what will happen in the future. Nobody knows that, but maybe you have an opinion about the trend. And the key of the question is, are returns in the tech area going back to more modest returns generally, as a lot of it has already been captured in 2020, and the pandemic acts as a catalyst for some stocks? Or where do you still see chances, and where the market is high already? And of course, the last but not least question, what is upcoming and new in Silicon Valley? Which trends companies are emerging?
Well, so I guess just take half a step back. Technology is still taking share in the economy. So the digital economy is still growing faster than the overall economy. So you think about dollars spent in the digital economy, it's becoming greater. It's not going away. The trends that we look for are not sort of things have happened and 2020 is done, and the drivers which made 2020 successful kind of stop as at the 1st of January 2021. That's not something that we agree with. We don't think that the drivers disappear. We think that move to a digitized environment that we talked about in terms of like the Pepsis or the BPs going more into cloud services, that is still ongoing, and we're still very, very early. The distributed workforce point is, I think it's pretty fair to say we're not going to be going back into the office 5 days a week anytime soon. And I think the certainly survey work we've done has suggested that employees and employers are keen to have more flexibility and allow for more flexibility in their workforce. So those kinds of elements have seen still like a step function change in terms of how they're being received by employees, employers. And then also those trends we saw in e-commerce, those are not trends which are going to basically get reversed anytime soon. And so you could also look at I guess how Amazon's performed over the last since October, since Pfizer announced their vaccine. Amazon's gone pretty flat. It's gone flat over the last 4 or 5 months, and it's been those second tier high growth e-commerce companies have done really, really well. Amazon's just kind of bumbled along and kind of stayed at a steady level. But don't be fooled into thinking that means that Amazon is not compounding growth at north of 30% per year, and in terms of that, compounding value by 30% per year. So there are some I guess companies out there who are still demonstrating a durable ability to grow at above normal rates of growth. And so I'm still kind of optimistic that those drivers aren't going away anytime soon. And technology is still gaining share of the overall economy. So within those kinds of parameters, it still looks like a market which still has a lot of opportunity. If I look at some of the top performing stocks year to date, so in 2021, there are names that are up over 20-25%, some over 35% in technology year to date of some of the names that we've been talking about today. So don't assume it's just going to stop. So the outlook, I think, is still constructive until we see I guess a point at which we think that the drivers change, those secular drivers are going to just stop and change. I mean, stop and change for what reason? If you want to become more efficient, if you want to reach your ESG goals like the BPs of the world, you need to adopt greater technology and digitization in your organization. There's no other way to get it done. There's no other way to improve productivity. We talked about AI at the start of this presentation. The way you become better at what you're doing is by embracing more data and embracing better ways to understand that data. And that, unfortunately, is not going to stop just because we've got, the stocks have done well on one particular year. So I'm still, I guess, pretty optimistic that there's going to be some bumps, certainly. There'll be rotation, certainly. I think the rotation we saw from October to now, where you saw a big rotation into more sort of value areas of the market, more cyclical areas of the market, whether it's energy, whether it's financials, that's going to happen. I guess this strategy was able to sort of stave off a lot of that sort of rotation bias through idiosyncratic ideas in the portfolio. So I think as long as you have a sharp eye on what the trends are, on where to be invested, then I think that's probably the most important part. I think the biggest mistake would just be to take a blanket view of technology and say, right, so technology's done well, I don't need to own it anymore. You need to understand individual companies, and unless you get down at that level, I think you're going to sort of struggle to understand what the drivers are, and I guess what the sort of the next winners could look like.
Okay, thank you very much, Julian. This was really insightful, and I had a lot of key takeaways from today's webinar from you. So thank you so much for being here today from San Francisco. I really enjoyed it, and I hope also our audience got all their questions answered and also gained so many insights like I did. So thanks very much, Julian, for being here today. And also big thank you to the audience which has stayed with us, and also for the question we had from the audience. So thank you very much for that. And I hope to see you soon at one of the next Scope webinars. Have a good day. Thank you. Bye.
Thank you, Barbara. Thank you. Bye-bye.